Hey traders, welcome back. Well, the first major jobs report of 2026 just dropped, and honestly, it is a wild one. We've got a headline number that looks pretty soft on the surface, but underneath all that, some of this data is running absolutely red hot. So let's dive right in and break down what this means for stocks, the dollar, gold, and of course, Bitcoin.
All right, let's just tackle the big question that I know everyone is asking right now. How on earth can the US add fewer jobs than expected, but the US dollar is actually getting stronger? I know, it feels completely backwards. But stick with me, because by the end of this, you're going to understand the market's strange logic perfect. So this report really, and I mean really, threw a curveball at the market today. It's sending some seriously mixed signals about where the US economy is actually headed. This isn't one of those simple good news or bad news days, and that's exactly what's creating some pretty incredible price action out there. And this analogy right here, it just captures the moment perfectly. The slowdown in hiring, well, that's the car taking its foot off the gas pedal. But that high wage growth, oh boy, that's the engine temperature gauge flashing deep in the red. So the big question for all of us is this a controlled safe stop, or is something about to overheat and blow? Okay, let's get into the nitty-gritty and look at the numbers causing all this noise. We're going to break down the 3 key data points that have pretty much every single trader glued to their screens right now. So first up, the headline number itself. Non-farm payrolls came in at just 50,000. Now that is a big miss from the 66,000 that economists were calling for. Taken all by itself, this number screams that the labor market is cooling off and maybe, just maybe, a little bit faster than we thought. But here's the first piece of the puzzle that just doesn't quite fit. The unemployment rate, it actually dropped to 4.4%. That's better than the 4.5% expected. So think about that. Fewer jobs were added, but the number of people out of work also went down. It's a surprisingly positive sign, right? And this is the number that is really causing all the fireworks. This is the one that has the Fed's full and undivided attention. Average hourly earnings, we're talking wages, they jumped 0.4% in a single month. That is way hotter than expected, and it's the key inflation warning that's keeping that economic engine overheating. And hey, for anyone who's new to this, NFP is basically the monthly scorecard for American jobs. It's one of the most powerful indicators of economic health out there, which is exactly why you see markets go crazy like this every single month when it drops. This chart really puts today's numbers into perspective. You can see that trend in job growth, that's the green line. It's been pointing down for a while now. But look at the unemployment rate, that orange line. It's staying stubbornly low. Today's report just poured gasoline all over that fire. Okay, so with this messy, confusing data as our backdrop, how did the markets actually trade it? Let's whip around the different asset classes and see who's winning and who's losing from all this confusion. Over in the stock market, it was not a clear risk-on or risk-off kind of move. Instead, we're seeing a much more interesting story playing out just under the surface. What we're witnessing is a classic case of sector rotation, where the big money is moving from one part of the market to another. So the broad S&P 500 is holding up, it's doing okay, but the tech-heavy NASDAQ is definitely feeling the heat. Investors are pulling money out of economically sensitive areas like manufacturing and are piling in to more defensive sectors, like healthcare and defense, that can better weather a potential slowdown. Now let's solve that puzzle from the top of the show. Why is the US dollar ripping higher after what looks like a weak jobs report? Well, the answer isn't in that headline 50,000 number. It's all about those hot wages. The dollar index, the DXY, has popped up to around 98.7. And here's the logic. That hot wage data is pushing US Treasury yields higher because the market now thinks the Fed simply cannot cut interest rates just yet. And those higher yields, they act like a magnet for foreign capital, pulling in money from all around the world and driving up the value of the dollar. It's as simple as that. Quick refresher here, the DXY is just a handy way to measure the dollar's strength against a whole basket of other major currencies. It's really the go-to benchmark for how the greenback is performing on the world stage. So what about Bitcoin? In a word, nothing. Yep, crypto is completely shrugging this report off. For digital assets, this data is pretty much a non-event. Right now, crypto traders are much more focused on geopolitical headlines and any regulatory news that's coming out. As you can see right here on the chart, Bitcoin is just chopping sideways. It's consolidating in this range between about $90,500 and $91,000. The US jobs market, it's just not the primary driver for this asset class at the moment. All right, let's move on to the real star of today's report. and that is gold. Because while other assets are kind of confused, scratching their heads, the precious metal has had a very clear and very, very powerful reaction. See, the market is looking at all this data through the lens of a soft landing. You know, that perfect, magical scenario where the Fed beats inflation without actually crashing the economy. And gold is reacting as if this report is the very first sign that the Fed might just be able to pull it off. So here's the crucial point. Gold is being pulled in two different directions. The weak jobs number suggests the Fed might turn more dovish sooner, which is bullish for gold, but the strong dollar from the wage data, that should be bearish. Well, today, the bulls are clearly in charge, with that soft landing story and a flight to safety giving gold a major boost. And you can see the result right here on this chart. Gold has broken out, pushing aggressively towards that 44.90 per ounce level. It's a huge vote of confidence from the market that the path of least resistance for the Fed is now tilting just a little bit softer. Okay, so that's the what, but now for the really important part, the what next? Let's lay out the key things you absolutely need to have on your radar to navigate this market in the coming days and weeks. Here is your 4-point checklist. Number 1, watch Treasury yields like a hawk. They're going to tell you if the market is still spooked by wage inflation. 2, keep an eye on the Fed rate cut odds. Are they pricing in a cut sooner or later after this? 3, do not forget the Supreme Court tariff ruling is on the horizon. That could be a massive volatility bomb. And 4, geopolitics are still in the driver's seat for assets like gold and Bitcoin, so stay tuned. This report has definitely shaken things up. A cooling jobs market paired with hot wages, well, it creates a ton of opportunity, but also a ton of risk. So what's your play? Are you buying this gold breakout? Fading the dollar rally? Let us know your move in the comments below. We read every single one. Stay sharp out there, and we'll catch you for the next market-moving event.